Left y-axis Nasdaq in black, right y-axis cumulative investment strategy in blue. Same here, left y-axis S&P 500 ETF, the SPY in black, right y-axis cumulative investment return strategy in blue. So in this video, we will show how by starting with just asset prices, we can derive a really highly profitable long-term investment strategy. Here is the conceptual blueprint for today's discussion. We will have three modules. The first, the frequency domain Butterworth Filter, then the Bollinger Bands module, and finally the algorithmic trading module. So the first step takes as input an asset price and then applies to it a low-pass frequency domain filter where you as a user can adjust the cutoff time period. In the second step, the filtered output, which is now smoothed and noise-free, is used as input to the Bollinger Bands module. Finally, in the third step, we use the output of the Bollinger Bands within a simple algorithmic trading framework, where as a user you can adjust also an SMA period to generate a highly profitable investment strategy. Quick disclaimers. We do not give investment or financial advice. We are only sharing our personal opinions. Now, to help us achieve all of that, we will use our quantitative investing dashboard, and we'll look for the Nasdaq-100 between, let's say, 2023 and 2025. We'll go to May, and we will use this page, the Bollinger Bands with Butterworth filtering. So this is the page that will be helpful to us. The top graph shows Nasdaq price and the bottom graph, the Bollinger Bands. So now here is the main structure of the algorithmic trading module. It has three steps: a pre-processing step, the basic setting or basic logic of the algorithm, and some constraints. So let's start with the entry of the trade. So this one, we will first take the asset price signal and then filter it using a low-pass Butterworth filter. The output of this filter is being used to generate the Bollinger Bands signals, so the lower, mid, and upper value of the Bollinger Bands. And the logic for the entry of the trade is to say, if the unfiltered price is above the lower boundary, and if we see an uptick in the lower boundary, meaning that the most recent price of the lower boundary is above the previous price, so in the case of using daily close data, that would be comparing from day to day the movement of this lower boundary of the Bollinger Band. So if these two conditions are true, and on top of that, if the unfiltered price is above a specific SMA, then we have a valid entry position. Now for the long exit, it's very simple. Whenever the unfiltered price goes below the lower boundary of the Bollinger Band, then we close and exit the trade. Now, we have taken the Nasdaq-100 over a long period of time, spanning 27.5 years between January 98 and May 2025. And here we have tuned these two parameters. So the cutoff period for the filter, we have set it to 250 days. And the SMA, here on the constraint, we have set it to 50 days. Now, before reviewing the performance of the algorithm, let's first discuss the assumptions and limitations of our method. So first, in terms of market microstructure, we do not consider any trading fees, any bid-ask spread, or market impact. Also, from a capital and financing point of view, there is no leverage, no interest rate financing. And from a profit and risk management, we do not consider any take profit limits or stop loss limits. So basically, our algorithm is rather simple. It's similar to a buy and hold position. So meaning whenever there is an entry signal, we just buy the index or buy the asset. without any leverage. And once the exit signal comes, then we just close and sell the position. So here are the results for the Nasdaq-100 from January 98 until May 2025. And the graph on the right shows you on the x-axis time, years, and on the y-axis gains or losses of each trade in percentage of position entry. So the green bars are positive, so it means this is like gains, and the red bars are losing trades. And so we see quite a few trades above 25% return, so 6 of them, and then 3 of them around 10 to 15% return. So in total, we have seen 28 trades, 13 winning and 15 losing, so a win ratio of 46%, a huge profit factor of 18, and you see a reasonably mild worst trade loss of 5.7%. And it probably is this one here that happened here in the first quarter of 2005. Some additional results for the Nasdaq-100, again for the same time period. This graph shows on the x-axis time in years. On the left y-axis, we have the Nasdaq closing daily price, so it's the black line. And on the right y-axis, we have the cumulative Nasdaq points earned or lost by this algorithm. So that's the blue line. And you see the blue line is quite robust, especially during bear markets. You see this period here, 22, 23. During the tariff period of the first quarter of 25, there was no loss. During the COVID pandemic, there is a bit of a loss here, but compared to what the index did, it's quite mild. And then during the financial crisis of 2007, 2008, actually it even increased. During the bear market of the dot-com bubble between 2000 and 2003, there is a huge gain first, and then a small loss and a stabilization. So this algorithm showed to be quite robust during volatile market conditions. As we also stated in the beginning of the video, we are looking for long-term investment edges. So in this case, the median holding period for this algorithm is 2.5 months, but it can vary also substantially around this median. It can be also, some positions can be held for a year or even longer. And then the median gain per trade is approximately 15%. So this is also good to see. It's a healthy number, especially if we have to consider, the trading fees and market impact whenever we enter the market. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Now, the algorithm performance comes with a caveat, which is mainly the fact that we have tuned the parameters specifically for the Nasdaq over these 27 years. So we might perhaps be overfitting, and now it becomes interesting to evaluate this exactly same algorithm without changing anything on other assets. Here we show the results of this algorithm on the S&P 500 ETF, the SPY, for the same time period, is 27.5 years. And the graph on the right shows you exactly that. So the x-axis is years, and the y-axis shows gains and losses with the bars, the green gains, and the red, the losses. So we have here in total 27 trades, 16 winning, 11 losing. So actually a higher win ratio, close to 60%. We have a similar profit factor of 17.1 we had for the Nasdaq 18. And the worst trade loss is now only 3.7%, so even lower than what we had with the Nasdaq. And we see 4 trades with approximately 30% gain on entry position, So when you look at this chart, yeah, it looks actually very promising and to some extent a little bit surprising that even using another asset, albeit correlated with the Nasdaq, delivers at least as good or even better performance compared to the Nasdaq. Here are some additional results for this algorithm when we applied it to the SPY index. And we see that the median holding period per trade is 7.5 months, so longer than for the Nasdaq. And the median gain per trade is approximately half of what it was for the Nasdaq. So now it's 7%. The chart on the right shows the results of this algorithm. So x-axis is time, left y-axis is the SPY index in black, the black line, and the right y-axis in blue is the cumulative return of the algorithm. And again, we see quite a stable algorithm during bear market condition 22-23, during the pandemic times, during the financial crisis, and then in the bear market of 2000, 2003, there's a bit of a loss, but overall quite stable. So this also looks again as a promising algorithm because as I remember that we have not changed anything. We're just using the Nasdaq algorithm as is with all the parameters and the logic and just testing it. So basically validating that logic on the S&P 500 ETF. Now we will use our quantitative investing dashboard to illustrate this algorithm. And also this dashboard is really handy to help you validate or visually confirm and validate some intuitive ideas that you might have. And often when I look at longer term trends, I find having a visual clues is very helpful to help you derive algorithmic trading modules. So we said we will, in this specific example, we will select 250 days, the cutoff frequency for the filter, and we will also use an SMA of 50. So the on the top graph, you see the blue line is the unfiltered price of the Nasdaq, the green is the filtered price, and the magenta is the SMA 50 of the blue line. The bottom graph shows in light blue the original unfiltered price, and then the three Bollinger Band signals. So in green, the upper boundary, in dark blue, the mid range, and the lower boundary is in red. Notice that when we look at the Bollinger Bands, they tend to almost overlap on top of each other, the three lines. And this is because these three lines are derived from the green line, the filtered line, which is now very smooth. It only keeps the very low frequency behavior, and any high frequency, any volatile behavior has been filtered out. So this is why you see also such a smooth boundary bands. Now, let us only keep the signals that we will need for our algorithmic trading. So from the top graph, we will remove the filtered signal. We only keep the SMA 50 and the original unfiltered one in blue. And from the bottom graph, we'll remove the mid boundary signal and the upper boundary. We'll only keep the red one, the lower boundary, and the light blue one, the unfiltered signal. So for the trade entry, we had three conditions. One, the unfiltered price had to be above the lower boundary. Two, the unfiltered price had to be above its SMA 50 days. And three, we wanted to check whether there was at some point an uptick or let's say a positive growth in the lower boundary. And this seems to be happening somewhere in April. If we look at here, April 12, we have 11,483, 44, 36.44. So on the 13th of April, 2023, that's where we start seeing the lower boundary increasing because dot 44 here 0.74 after, so it starts to really pick up. And at this date, so on the 13, which is here, we have a 13,100 in the DAX level. So now let's zoom out. So that's the entry because we satisfy all three conditions. And the exit, we said, will happen once the price drops below the lower boundary. So that happened on the 10th of March 2025, so almost 2 years later, and the Nasdaq was at 19,400. So that's a difference of almost 50% growth in 2 years' time. So this is how we can illustrate our algorithm using our dashboard. So the trade we just illustrated on the dashboard is actually this one here that did a return of almost 50% by early March 2025. And it's the one you see here, this huge bump into the equity curve of the trading algorithm that happened also so on that same date in March 2025. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Now, summarizing the algorithm performance on the both assets, so then where we designed it on the Nasdaq-100 and then we tested the algorithm on the S&P 500 ETF. For both, they have like very similar performance characteristics, approximately, let's say, 27, 28 trades. The main difference is in the win ratio. One is 46%, the other one 59%. The max loss streak or consecutive number of losing trades is 3. The worst trade loss is in more or less in the same kind of like range, say less than 6%, so between 3.7 and 5.7. A similar profit factor above 17, and also a similar holding period, so approximately 17 years. So this means that for about 60 to 65% of the time, we have a position in the market. And so this leaves quite a bit of time without using our capital in case we were only to use this algorithm. So this is why we also recommend or suggest to invest in US Treasury bills, so short-term Treasury bills from 1 to 12 months. Since these are really high quality and liquid instruments, and on average they have yielded between 0 and 5%, depending on macroeconomic conditions. But this is something we could complement this algorithm with this type of safe investments in US Treasury bills. We could even consider using this investment in parallel to this algorithm. So, like, let's say you would, for instance, split your capital in two, have 50% allocated to US Treasury bills, and then 50% to such an algorithm. And so, at least when the overall market is going down, is in a bear market, so at least you would have some return from the US Treasury bills because this algorithm will very likely not trigger. And also, it might help offset some of the losses of the algorithm that once in a while will also return a trading loss, but that might be offset by US Treasury bills. So this is something also to consider. Next, let's also do some additional evaluations of this algorithm. So we had designed it on the Nasdaq-100. We have first tested it on the S&P 500 ETF. And now we also want to test it on the DAX, on the Swedish stock market index, and on the Apple asset to see how does this algorithm perform. And we will again use the complete period, so from January 98 until May 2025. And what we see roughly in terms of number of winning and losing trades and win ratio, which is more or less in the same range for these new three new assets, so 48, 46, and 50%. The max loss streak is actually starts to really increase for Apple. We have here a number of value of 7. And we also start to see that the worst trade loss starts to pick up for these three assets. So we see the values of 7, 12, and even 15% for the Apple stock. The profit factor is actually drops substantially for the DAX and the Swedish index, but then increases also substantially for the Apple stock. So that's interesting. And then the holding period is more or less in the same range. I mean, give or take, so maybe 10, 15%. We are still in the same order of magnitude, so 15 and 18 years. But looking at these results, it does seem, even though Apple has a huge profit factor, it also comes with a big liability, and there was trade loss of 15%. So looking at these 5 rows, I think if we were to trade this algorithm live with real capital, then probably we would only stick to the first 2 assets, so the Nasdaq-100 and the S&P 500 ETF. What else also can we mention about this algorithm? If we look at the number of trades over this 27.5 years, we see roughly approximately 1 trade per year on average, which is actually a good thing because it means that this algorithm, comes with low cost and low fee. It means that it's really a long-term investment strategy, and we all know especially from Professor Burton Malkiel's book, that the more frequent the trades are, the more that will also impact our return with additional trading costs, additional fees, additional costs due to market impact. So actually, this is a good thing to have, a low number of the amount of trades for the period that we are considering. Now, the next analysis that we will perform is to say, okay, let's keep exactly the same algorithm with the same parameters, but we will remove the pre-processing step. So we will remove the filtering part that was used in the long entry logic, and now we will just use the Bollinger Band signals derived directly from the unfiltered original price. So what would that deliver if we were to apply this again to the Nasdaq-100? And this is what we see. So without price pre-filtering for the same time period, so from January 98 until May 25. And here are the results. So we have more than tripled the amount of trades, 3.5 times as much as what we had before. The win ratio is more or less in the same ballpark. And this also means if we triple the amount of trades, we will also have additional costs. So more trading fees and more costs due to market impact. What else do we see? We see the profit factor drops by a factor of 9 approximately. So a huge drop in the profit factor. And the worst trade loss also increases, a doubling of approximately of the worst trade loss. So the performance really deteriorates if we remove this pre-filtering step. And we see here on the right the graph that shows the trade results. So x-axis is time, y-axis shows the gain or losses in percentage of position entry. So the green bars are gains and the red are the losses. So you see right away way more trades and also a lot more smaller gains than what we used to have before. So this is also some interesting result to evaluate and consider. Finally, for the next video, we will look at the MACD, the Moving Average Convergence Divergence Indicator, and we'll see how we can combine it also with the Butterworth frequency filter. Thank you for watching, and until next time.